Can move on to the third technical session on accounting as per IFRS. To handle this session, we have an eminent speaker, none other than CA Anjani Khetan. May I request V.T. Shetty, Secretary, to escort the speaker onto the dais. Welcome and floor, okay? Thank you, sir. I take this opportunity to give a brief introduction of Mr. Anjani Khetan. He is a fellow member of ICA with about 22 years of post-qualification experience in leadership roles with renowned business organizations, both in industry and in one of the big four accounting firms. In addition, Anjani is also a CFA, an associate member of ICWA, and licentiate member of ICSI. Anjani is currently based out of Bangalore and is working as a regional head of finance in a MNC company. Anjani's core competencies include managing entire gamut of finance, treasury, taxation, both domestic and international taxes, transfer pricing and corporate accounting, including compliance with US GAAP, IFRS and Ind AS. He is a visiting faculty for ICA's training course on Ind AS for last 5 years. He is also in the panel of shortlisted faculties by ICA for goods and service tax. He has contributed articles in professional magazines like Chartered Accountant and Chartered Secretary, with the latest one on lease accounting under IFRS 16. In August 2016, issue of monthly journal Chartered Accountant brought out by ICA. With this brief introduction, I present before you Mr. Anjani Khetan. Over to you, sir.
Hello everyone. Welcome to see such a large gathering on a Saturday afternoon post lunch. It's the most difficult session. So it's a really daunting task for me as a speaker to keep you all awake, and that too talk on accounting, which seems to be a very dry subject for most of us. Having said that, yes, my endeavor would be to keep the session interesting and interactive, so that at least we do justice to your weekend afternoon. Okay. With that said, I know you already had 2 sessions in the morning with respect to your derivatives and equity and mutual funds, which seem to be slightly kind of a technical issues. Okay. This is also not. The slides are not. Even if manually it is not. Okay, so if I recollect your, the agenda talks about accounting under IFRS, but if you see the subject line here, I am saying accounting under IFRS and Ind AS. The reason is because in India, actually what we follow is Ind AS. Of course, Ind AS is based on IFRS, and that is the reason I have slightly tweaked the heading of this particular discussion to say accounting under IFRS and Ind AS. But rest assured, most of the concepts which we will be talking today is very much there in Ind AS as well as in IFRS. So what we will do over the next about an hour and a half, we would be talking about some of the these topics like what IFRS is and why IFRS was required, or why India actually wanted to go for convergence to IFRS and adopt a new set of standards are called Indians. And having understood that, what is the roadmap which the Ministry of Corporate Affairs, MCA, has laid out for the corporates, followed by, so this is more of an introduction, followed by the key discussion point in terms of how life is going to change under Ind AS vis-a-vis what we have currently, let's say, under Indian GAAP. Okay, so some of the significant impact areas, how things are going to change, under Ind AS is what we will look at, and then of course as a summary I have included some of the key takeaways that basically summarizes whatever we would have talked about in the prior slides. So first thing first, what is IFRS and why IFRS? So if you look at, typically when you say IFRS, if you see this side, this IFRS stands for International Financial Reporting Standards. As the name itself suggests, these are the financial reporting standards internationally, which has international applicability. So these are set of global accounting standards. IFRS basically is a set of global accounting standards which have been developed by IASB, International Accounting Standards Board, and including its predecessor, which was IASC, rather than board, it was a committee. So International Accounting Standards Committee. So it's like right now we have IASB as the premier body who issues these IFRS standards. And what they intend to do, these IFRS standards, basically they help preparers to prepare financial statements and other financial and comply with other financial reporting. So they are basically, now if you see in the next slide, what they do, they can help to increase quality, comparability and transparency of financial statements. Okay? And effectively, IFRS has become a global accounting language. Why so? Because today, if you look at the global, globally across the world, we have more than 100 countries which have either adopted IFRS as it is or have converged to IFRS. So, for instance, countries like India have gone for convergence path, whereas countries like, say, Pakistan have gone for adoption path. Now when we say convergence, similarly, let's say if you look at Singapore or Philippines, they have also gone for convergence. The main reason why India chose to go for convergence path rather than the adoption, the major reason was that yes, we wanted to have our global standards, but we also wanted to move away from the globally issued standards to take care of specific Indian business nuances. And because of which, we wanted to give some amount of flexibility to our standard setters and our industry so that our standards, yes, they are very much compliant mostly with the IFRS and the global standards, but there is some amount of flexibility depending upon what the standard setters or regulators in India feel. That's something which should be doing. And that is the reason why we in India have gone for convergence path rather than the adoption path. So we'll see a brief introduction about what Ind AS is and what is the roadmap which MCA has issued for corporates. Of course, there are separate roadmaps applicable for NBFCs, insurance companies and banks. So we are not covering those as part of today's conversation, maybe some other time. But as of now, we are only covering roadmap which is applicable to corporate entities. Okay. So what it is? Now we are switching here. Now we are actually, rest of our, as I said, the discussion is based on Ind AS rather than IFRS. And as I said, Ind AS are converged. Very much they are aligned to what are the requirements of IFRS. So what it is so Ind AS essentially represent 39 accounting standards. And in next slide, I will show you a mapping in terms of how our standards compare with the standards which we have globally under IFRS. Okay, one-to-one mapping I will show it to you. But they represent essentially 39 accounting standards which are largely converged to IFRS. And these Ind AS are formally issued by MCA. Of course, ICI takes the lead in terms of framing these standards. And then Periodically, MCA also issues amendment to the India. And why so? The major reason why we issue amendments is to keep pace with whatever changes are happening globally. So I'll give a simple example, okay? So today if you look at, as of 1st of April 2018, we have a new accounting standards in under Ind AS as well as under IFRS. Of course, IFRS is 3 months earlier, but from India perspective, starting 1st April 2018, we have a new revenue recognition standard. That's called revenue from contract with customers. We will see, few slides and deep dive into what that standard is as part of today's conversation. But what I'm trying to say is that before this standard, newly issued standard, we have earlier versions of standards dealing with revenue, which was Ind AS 11 and Ind AS 18, dealing with construction contracts and revenue per se. Okay? But now what we have is these, because globally IFRS 15 was issued to keep our standards aligned with the international developments, we also issued in India Ind AS 115 to correspond to the new revenue standard under IFRS. Okay? So periodically the amendments are issued mainly to align the whatever developments are happening globally. India should also reflect those. Key highlights I already explained to you. If you look at the middle box, that we have gone for convergence path, not adoption. Interestingly, if you look at, India actually became first country to adopt some of the newer standards under IFRS. So for instance, Ind AS 109, which corresponds to IFRS 9 globally, dealing with financial instruments. In fact, India was the first country to adopt IFRS 9. Okay, ahead of any country in the world. The reason was very simple, because the thought process, was that since we are anyway adopting Ind AS, why not we'll start with even IFRS 9 as well, so that you do not need to do one more transition to the new standard. Okay? And of course, because of the fact that we have gone for convergence, the whole idea was to have some flexibility to our industry. That's why Ind AS has certain carve-outs, okay, to accommodate Indian business nuances. When we say carve-outs, they are slight exceptions where we say, okay, globally, let's say fair value is required to be applied, or fair value is an option given. We may say in India, okay, fair value is not allowed as an option. So say for a simple example, if you look at investment property, okay, in investment property, in accounting dealing with investment property under IFRS have both the options. That when after you have acquired investment property, subsequently, when you do subsequent measurement, you have a choice to apply cost model or fair value accounting model. But in India, we have said no, we do not allow preparers fair value model. So it is like a carve-out where we are saying that yes, it's an exception, we are not allowing that. Okay. Having said that, there are not too many carve-outs. So essentially, Ind AS and IFRS are very much aligned. Again, transition to IFRS, or for that matter Ind AS, okay, is not just an accounting exercise. Many of us would believe, let's say we are moving from Indian GAAP to Ind AS, we may think that it is an accounting exercise. Actually, it is not. And in subsequent slides, we'll see how life is going to change. So, if we do not keep all the stakeholders involved, there will be surprises in the business which nobody wants. Okay, I'll give a simple example. Okay, and then we will move ahead. This has the example which I am giving will have linkages to subsequent slides to come as well. So let's say a simple thing. Today, if an entity issues compulsory redeemable preference shares, what do we do with the Indian GAAP? In Indian GAAP, these preference shares are considered as equity capital. But here, life will change under IFRS and Ind AS. Because under Ind AS and IFRS, you need to apply the test of equity or liability when we are classifying any financial instrument as whether it is a liability or a equity. So what happens? essentially, if you look at what is the character of a compulsorily redeemable preference share, what is the real character? It is actually in the nature of a debt, because you know you have to redeem it, you have a liability which you cannot avoid, right? During the time they are not redeemable, you pay preference dividend to them, that's an obligation to you, because unless and until you pay those preference dividend, mostly you will not be able to pay your equity dividend, right? So in essence, basically dividend is also kind of your liability, and you have a known liability when these instruments will come up for redemption. So that's why under Ind AS these instruments are not classified as equity, they are classified as debt. The problem starts here. The moment you say it is debt, the preference dividend which you pay takes the color of interest. Means what? Now, if it takes the interest of of a debt instrument or an interest, you have to deduct for the purpose of computing your profit before tax, at least for the purpose of accounting, which means your PBT changes. Now imagine if you have executive compensation linked to profit before tax, without doing anything, just because you have moved from Indian GAAP to Ind AS, the executive's compensation may be at stake, because now the profit has come down to the extent of the preference dividend which you have declared on the same instrument. Because the accounting is different, the very same preference dividend now takes the color of interest, and it is kind of a, so for computing PBT you have to deduct those. So that's why, assume one more thing. You might have given, when we say that it takes the color of or it becomes a liability or a debt, your debt equity ratio goes for a change. You may have given, you might have taken loan, let's say from an institution, and in that you might have given some debt covenants, debt equity ratio to be maintained. Now nothing changed, but because it is the equity is classified as debt, your covenant might change, and you may not be able to comply with your debt covenants. What is the other implication? If you look at most of the agreements with the bankers, you will see, if you breach the covenants, loan becomes immediately payable. So your loan, which is otherwise long-term loan, it becomes currently payable. It becomes current liability now. So if you see, that's why I am saying it is not just an accounting exercise. It has wide-ranging implication. In the example which we saw, it may impact executive compensation, which means your HR has to come into play to make sure that they do suitable amendment to employee, your compensation letters. You may have to involve your legal team to renegotiate your debt agreements with your bankers, right? Your balance sheet composition changes. You have to engage yourself with your shareholders, audit committee members. So that's why it is not just an accounting exercise. Okay, we'll move on. We have a lot more to cover. If we want to cover this, we can keep talking on this aspect itself. Again, India is in dynamic stage, because as I mentioned, whatever developments are happening globally, we also need to keep pace with those changes, which means newer standards when it comes globally, we also have to issue similar standards. So just for your information, lease accounting is going to go a significant change starting next few months. First of April 2019. Okay, so just 1 month from now, we will have a new lease accounting standard. Not that we do not have existing lease accounting standard, we do have, but the new standard will replace the previous ones. So I have covered a couple of slides to see and give you a glimpse of what changes are expected to happen because of that new standard as well. Okay, and why? Because why we wanted to move to India, as I already shared, that this IFRS has become a international kind of an accounting language. So if you move to this, your listing to stock exchanges, foreign stock exchanges becomes far more easier. Your cross-border, merger and acquisitions could be, it can facilitate that. It can also allow you to holistically relook at your systems, processes, and that also indirectly will help you in bringing efficiency and improvement in your entire business model, entire system. So this is what the preliminary slide is in terms of what Ind AS is, what are the key highlights, why we want to adopt Ind AS. Let's move on. This is the slide which tells you how you have a mapping from IFRS to corresponding Ind AS literature. So if you see here, you will see IFRS 1. If you recall, just a couple of minutes back I said IFRS are issued by IASB board, International Accounting Standards Board. The predecessor body was committee. So all the IAS series of literature which you see here, these were essentially issued by IASC. Now if you see, you have IAS 1 also, IFRS 1 also. There are two separate series, but then each one is suffixed by 1. So that is the reason what we did in India. For all the IFRS series of literature, we have followed the same convention but in 3-digit number. So IFRS 1 means corresponding literature, Ind AS 101. IFRS 4, you have corresponding literature, Ind AS 104, like that. Okay, IFRS 9, corresponding literature, Ind AS 109. So 100 series of hundreds. Okay, but when it comes to IAS series of literature, what we have done, it is 1-to-1 mapping. IAS 1, Ind AS 1. IAS 7, Ind AS 7, like that. So that's the way the mapping is. Okay, and one more thing what we have done is that globally, wherever there was a requirement, there were certain interpretation or clarifications were also issued over the period of time. So what we have done under Ind AS, let's say if a particular interpretation related to say income tax standard. Okay, so what we have done in the income tax standard dealing with which is Ind AS 12, we have incorporated as an appendix to Ind AS 12 their respective interpretations. So in Indian GAAP scenario, we used to have ASIs, right? Accounting Standard Interpretation. Similar thing, whatever interpretation is there, those interpretation is something which we have added as an appendix to the respective standard under Ind AS. Are you okay with this? Okay, let's move on. Now, how life is going to change? First, substance over form. I already gave an example of redeemable, compulsory redeemable preferences. What is the substance of this transaction? It is a debt or a liability. So, under Ind AS and IFRS, there is a lot more emphasis on substance rather than the form. You will invariably be disregarding form and will give precedence to what is the real substance and do the accounting accordingly. There will be a whole lot more use of present value and fair value. I'll give you a simple example. Let's say today, if you have to acquire a new company, so let's say you are acquiring a target company, okay? So in that, under Ind AS and IFRS, you have to value the assets and liabilities of that target company using fair value. You cannot use book values, except when there happens to be a common control transaction. Okay, so mostly you would be using fair value for those kind of a transactions. So which means under Ind AS and IFRS, you will see a lot more use of present value and fair value. A lot of estimates and judgment would be involved. Focus will be on risk and reward. A restatement of previously issued financial statements. Very important and interesting. So let me explain it to you what it means. Let's say today you figure out that 3 years back your audited financials had some error. What the Ind AS says, you have to reopen your financial statement. You have to correct that material prior period error as if the error never ever happened. So actually it leads to restatement of previously issued and audited financial statement. Very dangerous thing, especially for an accounting function. If this restatement happens, it's like a blot, right? It's a stigma. Okay? Detailed disclosures. A huge amount of disclosures are required when you move from Indian GAAP to, I'm saying relatively speaking, obviously not that in Indian GAAP you do not have disclosures, but if you look at it on a relative basis, huge amount of disclosure requirement in the Ind AS and IFRS. And concept of first time adoption is a very unique concept under Ind AS and IFRS. What happens? First time when an entity moves from the current GAAP to IFRS or Ind AS, there's a concept of what is called first time adoption. What is it? It simply allows the first time adopter certain options and exemptions. So there are mandatory, exemptions and optional exceptions. Okay. So these exemptions and exceptions are something which so when there is a mandatory, you do not have a choice, you have to follow that. But when it comes to optional exemptions, you have a choice, you may not follow. I'll give a simple example. Let's say a company is 150-year-old company. Now today, if the requirement is that you do the accounting as if you applied the Ind AS or IFRS for all of those 150-year-old whatever business combination you have done, it's an impossible task. So that's why these standards when you are adopting first time, it gives you an option. Okay, don't do a restatement of prior business combination, but there's a choice given. If you want to still do it, if you have all of those information, you have a choice. You can do, even prior business combination also you can account using the principles of IFRS and Ind AS. But there's an option given. So basically, this standard, IFRS 1 or corresponding Ind AS 101, it makes life easier for the first time adopter. Okay, let's move on. Now, this slide captures the roadmap for Ind AS implementation for corporates. There are a lot of things here. Read the chart the way I am reading it. It is very easy. Okay. So this is only for corporates. So you see here, phase 1 is 16-17, already gone, right? If you have 16-17, corresponding comparative period will be 15-16. So that was for phase 1 company mandatory Ind AS adoption or Ind AS convergence that started from financial year 16-17 with a corresponding comparative 15-16. And to whom this was applicable? This was applicable to this set of companies. Phase 1 applied to all listed companies with net worth of 500 crore rupees or more. That's for listed company. And for all unlisted companies with net worth of 500 crore rupees or more. Which means, as long as you are a company, your net worth is 500 crore rupees or more, whether you are listed or unlisted, you are all covered under phase 1. You have to comply with Ind AS requirements from financial year 16-17. Already gone. What happens phase 2, which is just 1 year later, that is 17-18. So what we are trying to do is we are trying to bring more and more companies within the fold of Ind AS. So what we did in come next year, that is 17-18, under phase 2, listed company irrespective of the net worth. All listed companies covered under Ind AS. But when it comes to unlisted companies, we are saying, okay, threshold we are reducing from 500 crores to 250 crores. And it doesn't stop here. If a company is covered, the entire group is covered in the other areas. And it's a one-way traffic, which means once you have adopted or once you have started applying Ind AS, you cannot move back. You have to continue to apply Ind AS. So assuming that you were under a bracket of 250 crore net worth company. Next year, after you started implementing Ind AS, next year, let's say you had a loss of 150 crores. 250 became 100 crores. Your net worth is below the threshold of 250 crores. You can't go back to the previous cap. You have to continue to apply. Yes. That's the essence of this. So if you see next slide, that gives you this. And by the way, there was a voluntary, if you see at the end, there was a voluntary adoption also which was allowed, which was 1 year even prior to for phase 1 company. So 15-16 itself, if a company wanted to apply early, they could have applied Ind AS starting 15-16. So in my company, we actually started voluntarily from 1560. Okay. So if you look at here, this chart tells you for the mandatory implementation. So mandatory 60-70. So this period is your first period of first financial statement under Ind AS, and March 2017 would be your reporting date. Correspondingly, comparative would be 15-16. But there is one more thing which you have to prepare. You have to prepare this statement. This is called opening balance sheet. So this statement is also on the basis of Ind AS. So this balance sheet this is the third balance sheet in this example, right? The third balance sheet is dated 1st April 2015 under Ind AS. But applying which Ind AS standards? That's the question. There, in this example, when you are preparing this statement, opening statement, you have to apply accounting standards applicable on this date, which is 31st of March 2017. So, let's extend this argument to current year, 18-19. If somebody is falling under 18-19 here, you have to do the prior accounting, unless a new standard has some transition related options. If the transition options is given, then you apply the transition options given in the standard. Okay, so now this was kind of a prelude. Okay, now we will get into the meat of this presentation in terms of looking at what are the significant impact areas which we are expected to see how things will change. So if you see this, tell me what is left. There's nothing which is left. Everything you talk about, revenue, fair value, disclosures, business combination, consolidation, stock comp, like ESOPs, leases, financial instruments, what is left? On your financial statement, hardly anything is left, which is not impacted. So what we will see? We will see few of them. Given the time which we have about an hour and a half, I thought I will pick up revenue, financial instruments, and leases. Business combination, time permitting, I will put it a couple of slides. Business combination and consolidation, we will briefly touch upon it. Okay. So let's first see revenue recognition. So as I mentioned, that Ind AS 115 has kicked in from 1st April 2018. 18-19 is the first year when we will be applying this standard. Now with that, as I also mentioned that earlier you had corresponding literature Ind AS 11 and 18 that has been superseded by the new standard. Now this new framework or the new standard 115, it focuses on performance obligations in a contract and allocating the transaction price to those obligations. It's a very simple thing, terminology apart. I'll give a simple example. Today you go and buy a car, new car. What happens? You get a car and they will say, okay, next 12 months, 24 months, 36 months, AMC is free. Nothing comes free in this world. Right? So essentially what is happening, when you are going and buying a car, you are buying two things. You are buying a car plus an AMC also. So what this new requirement is, or the standard says, look at, in any transaction, you first look at what are the obligations which you have. I as a seller, what obligations I have undertaken. So in the example which I gave, I have two obligations, deliver the car and have AMC for next whatever period I have agreed upon. Right? For that, combined price less 15 lakhs, assume you have paid to the car dealer 15 lakh rupees. Now 15 lakh rupees is a consideration which you have given for the purpose of buying the car as well as for AMC. So essentially this standard requires you to split that 15 lakhs into the corresponding element of what is applicable for the purchase of car and what is for the AMC. So that's what the meaning of this middle portion of this line. Okay. So framework focuses on performance obligation in the contract and allocating the transaction price to those applications. And this new model is a control-based model rather than risk and reward. It does not mean that risk and reward is no longer important. No, they are still important. But this is just one of the factors which determines whether control has been transferred. But then essentially the framework, this model is based on control, which means when the control has been passed on from the seller to the buyer. Okay, we'll see more into this in coming slides. So let's see here. So what happens? This standard, this is the core principle of this standard. What is the core principle? I'll go slightly slow. Very important to understand what it says. Core principle is recognize revenue to depict transfer of promised goods or services to the customer in an amount which reflects consideration to which the entity expects to be entitled to in exchange for goods and services. Important point is it says entity expects to be entitled to. It does not say entity is legally entitled to. Right? I'll give a simple example. In many of the industry, I think everybody will find that those examples. Let's say I am the supplier, I am the seller. I tell my dealer, depending upon how much quantity you take in an year, I'll pass on to you some volume discount. Now, neither I know nor my customer know eventually at the end of the year what would be the actual volume. I may have an estimate, the other party also may have an estimate in terms of what is the likely offtake. But none of us today, when we are entering into this arrangement, would actually know with certainty what is the actual volume. Which means you would not know what would be the discount which you will be eventually passing it on to the customers. So assuming that, if I say if you buy 1 lakh units, I'll give you 10% discount. If you buy 80,000 units, I'll give you only 5% discount. Now, in between 50 and 50,000 and 1 lakh, I think you will still be entitled to 5% discount. So what this core principle says, that you should recognize revenue first to depict transfer of promised goods or services. How much of the goods and services which you have promised has already been transferred to the customers. And important point which you have to look at is you should recognize revenue only to the extent, in the basis of what you expect that you will be eventually entitled to this, to the purchase consideration. And to give effect to this core principle, it introduces this 5-step principle. So this 5-step principle, this tells you how you should go about doing the revenue recognition. Okay? The first one is, first of all, you identify whether there is a contract with the customer at all. And then it has defined what is a contract and how and in which situation you will consider that the contract exists. Then identify performance obligation, determine what is the transaction price, allocate the transaction price to those performance obligations. In my example, 15 lakh rupees to car and AMC, and then recognize revenue either at a point in time or over a period of time. Okay? So let's see each one of these 5 steps. We will slightly move further and look at each one of them. Okay? So let's see. First one, identify the contract with the customer. First thing first, as we know, Indian Contract Act tells you contract need not be written. Same concept applies here also. If you see at the bottom, it says, what is a contract? A contract is an agreement between 2 or more parties which creates enforceable rights and obligations. It can be written or it can be oral. It need not always be oral. Of course, it's always preferred to convert it into writing. Okay? But then, in the context of this standard, when would you say that the contract exists? Because this is the starting point. Unless and only contract exists, you cannot start revenue recognition. So, a contract exists if these conditions are met. What is that? a contract exists if legally it is enforceable and it is approved by the parties to the contract and the parties are committed to their obligation. Okay, next step. Rights to the goods and services is identified and payment terms can be identified. Fourth, collection of purchase consideration is considered probable. So if everything is there, consideration is not probable to be received. You defer. You don't recognize revenue. You wait till the time this condition is met. And the last one is the contract must have commercial substance. All of these conditions must be met before you conclude that it is a contract which exists within the framework of this standard, and only then you will start recognizing revenue. Step 2. Step 2 is identify performance obligation. Similar to what I gave an example of car and AMC. So let's see what it is said. At contract, if you see here, at contract inception, an entity is required to identify the performance obligations under the contract, and these obligations are identified either on the basis of contractual terms and conditions or customary business practices as well. And these performance conditions could either be explicit or implicit in the contract. You can either specifically call that out in the agreement, or it could be implicit, which you have agreed. So this could be explicit or implicit within the contract, right? So it can be either of these. Okay? Just move on to next step. I'll explain, with the example of how we consider and how do we see whether you have a multiple performance obligation or a single performance obligation. I already gave an example of car and AMC where you have two performance obligations. Now let us see an example of a single performance obligation. So say for instance, you go to a contractor and you say, construct a house for me. Now in that process, the builder might buy the raw materials and give construction services. He may buy bricks, windows, other accessories, fittings, and he will also then do the construction services. Now the question is it a single performance obligation? Are you buying a house or are you buying each one of them? Answer is obvious. You have gone to buy a house. You are not concerned about the specific procurements which he might have had in the process of constructing the house. So in this case, there is a significant integration service which the builder is providing, and because of this integration, all of this actually culminates into building a house. So in this example, this is a single performance obligation. Unlike the previous one where you had car and the AMC, which are two performance obligations. We will see one more example. So here, this is an example of multiple performance obligations. So let's say you buy a Xerox machine and along with a standard installation process. So somebody will come and with a standard installation they can do. Now here if you look at, because it's a standard installation does not require any specific knowledge. Okay, you may also end up either doing this installation on your own, or you may have a nearby technician in your vicinity. You can call them and the person can do it for you. It is not dependent upon the vendor. So there is no kind of, unlike the previous case where there was significant integration activities which was done by the builder, there is no such kind of a significant integration activities which is being done, and that's why they are two different performance obligations. Same, if you extend the same argument to our car and AMC, you did not get it done from the car dealer, you can do it from somewhere else also. So there is no integration activities which are there, that's why they are multiple performance obligations. Let's see further. Now, step 1, what we said, identify the contract, step 2, identify performance obligation. Third, transaction price, determine transaction price. In my car example, it was 15 lakhs, but that's a simple example. in many circumstances, your purchase consideration may not be fixed. It may have some variable element. One example which I gave, variable element is discount or the volume discount. Right? Another example. Let's say if you are getting, say, house getting built or any construction activity, you may have, certain bonuses linked. You may say, if you complete this work in 6 months, you are entitled to 10% bonus. And if it doesn't happen in 6 months, you are not entitled to the regular compensation. No bonus is given. So which means here there is a variability in the consideration, because depending upon whether that work will be completed in next 6 months or not, you are entitled to a different purchase, consideration. So that is why this standard also requires you to estimate the transaction price, which may also involve variable consideration, not necessarily fixed. Okay? For that, it gives you two different methods. How do you estimate? So this is what it says. When you are trying to estimate the purchase consideration, you either apply the expected value method or most likely method. And then one more condition it says, that when you are applying this variable consideration, be conservative. It's an indirect way of telling, because it requires you to constrain. If you see here, it requires you to constrain the assessment of what would be your likely consideration, and you should do that in such a way that there is no significant revenue reversal in subsequent period of time. So I'll give same example of that volume discount. So assume that you thought, let's say the price per unit was 10 rupees. When the contract happened, you said 1 lakh rupee, 1 lakh unit, 10% discount, which means 1 rupee discount you are supposed to pass on. But then you are not sure whether he will have 1 lakh or not. But you were estimating internally he may reach around, say, 90,000 units. But then it is very close to the threshold of 1 lakh. But if suppose there is some business change which allows him to have higher offtake, if you recognize on the basis of 5% discount and not 10%, it will lead to significant revenue reversal at a later point in time. So what is the standard? Without specifically giving exactly what you have to tell, it only tells you a guidance. It gives you a guidance. Then when you are when you are computing this transaction price, that you apply this constraint. And the overarching principle is you apply this constraint in such a way that subsequently it should not result in the significant reversal of revenue. We are okay with this? Postal section, this is difficult, is it? No? Is okay? Good.
Can I have a question?
Yes, sir, please.
On the example of the car and the AMC.
Yes.
For the car, how will you estimate that what is the
We'll come back. This is there. It is there. In coming slide, we will see. Just to give you an answer, this is something called relative standalone selling price. We'll see this. I will include an example also. So we will see, numerical example also. Okay. So continuing with step 3. Again, we are still on how to determine the transaction price. Now, take a scenario. You go to your, okay, so let's continue the same example of our dealer. We'll come back to the slide, but I'm just trying to make sure that you understand the concept. So let's say you are going and selling to your customer, and the customer tells you, I'm not going to pay you in next 2 years. You sell me now, I'll pay you after 2 years. Typically, your payment period is 60 days, 90 days. But that you are giving that concession to that guy, and you are giving the flexibility, okay, you pay me after 2 years. Now, India is an IFRS has a different requirement. It says the fact that you are giving them additional credit period, it is actually the nature of financing which you are giving it to that person. So, split that. Whatever amount which is giving, out of that, split what amount relates to the financing arrangement. Because it is the fact that you are giving an extended credit period, assume that 10% is the interest rate, assuming that 10% rate carve out what amount of that 1 lakh relates to interest, that amount is your interest income. And the balance is actually only for your goods and service. Okay, so that's why. Why? If you understood that, this is what the crux of that. What the standard also tells you, don't go too much into it. It has given something called a practical expedient. 1 year. 12 months period it is. Okay, if you give up to 12 months, no adjustment is required. Okay, so that's a practical expedient that is given. So if you see, if you are doing that or performing your obligation here, 1 year from this side, 1 year from that side, okay, don't do anything. But if it is more than 1 year, either side, then you adjust your price. So I gave an example of where you are telling the person, you pay me after 2 years. It can be ulta, you can reverse, it will be reverse also. You may say, you pay me now, I will deliver after 2 years. Then that would mean that person is giving you money. Right? So either way it will work.
How will it work if many contracts have a retention concept?
Okay, so retention is slightly on a different footing, and retention, if you look at, it will be a very specific percentage, maybe 5 to 10%. To that, there can be a view that you do not apply. Retention has another issue, MSME compliance. Don't bother about, so don't forget about that as well. Recently introduced MSME, we have a lot of issues out of that. You would have paid everything to MSME, but still 5% or 10% whatever you would have kept as a retention as an issue. Okay, moving on. Not to digress further. Okay. Step 3, continuing with, we are still continuing on the transaction price. So if you see here, sometime it may happen, we have only seen right now considered fixed price or variable price. But sometime it may happen that the price which you pay is not in terms of money, but by way of non-cash consideration. So say for instance, I as a company, to my vendor, I have issued some shares to discharge my purchase consideration. It's a non-cash consideration. So to that, what the requirement is, if you have that kind of a scenario where there is a non-cash consideration, you do the fair value of what you are giving. So if you are giving shares, you look at the fair value of shares. So as an example, if company A is listed on a stock exchange and its share is 100 rupees and you give 10 shares, 1000 rupees is what you should include in your transaction price. 10 price into the number of shares which you have. And if it is not there, then use standalone selling price of the goods or promised in exchange for. So that's the priority is to use the fair value of the non-cash consideration. Failing which, you use the standalone selling price of the goods promised. We'll see one more thing. Now, 3 steps which we have seen. We have identified, yes, there is a contract. What performance obligations are there under the contract? What price you are paying? Now, next question, what you raised, sir, how do you allocate? That's how it is. So, allocation, if you see, an entity needs to decide how to determine, first of all, what should be. So, let's say two performance obligations, car and the AMC. How do you determine what is their prices? And then how to allocate. The objective, we'll see an example. So first let's see the theory. It says the overarching objective of this allocation methodology is that you allocate the transaction price to each of the performance obligation in a way that it depicts the amount of consideration for transferring promised goods and services. And to that, you will apply these two. What will you do? You will determine the standalone selling price. Simple example. Suppose, same example of car and AMC. You go to the car dealer and you say, assuming you have that option, okay, that I do not want AMC, you just give me the car. He says, I will give you 14.5 lakh rupees, not 15 lakh rupees. Okay. But that vendor also gives you AMC alone. I have a car from some other company, or maybe same brand car, old car, but I just want an AMC for next, whatever, same period. So let's say the AMC is for 2.5 lakh rupees. Now 14 and a half, and then 2.5, 70 lakhs. If you would have bought those two things independently, you would have paid 17 lakhs. Combination, you are paying only 15 lakhs. So the standalone selling price is 14.5 lakh and 2.5 lakh. In that ratio, you allocate 15 lakhs. Simple. If you look at intuitively, it makes complete sense. If you have bought it in independent transaction, you would have paid 14.5 and 2.5. 70 lakhs total what you would have paid. You are actually paying 15 lakhs. Then allocate. That's the basic principle. Okay. We'll see this. So to determine this standalone selling price, this is what the requirement is. In my example, which I said, 14.5, 2.5 was available to you. So the price, this was available. It was observable. Okay. But sometimes this is not there. Then in that case, the standard gives you that these three methods to estimate what should be the price, which should be formed part of the allocation methodology. Okay. So first one is adjusted market price, market assessment approach, cost plus margin, and then residual approach. Essentially what is happening in the first one, you evaluate the market, you look at the market, and then for those goods and services, and then estimate the price that the customer will be paying in that market. See, but you understand the basic principle. What it says is here that you look at the relatively how valuable they are, and in that ratio you apply the allocation. We'll see this with one example. I think, yeah, here it is. Now if you see here, you have a mobile phone and a data connection, which is a combo offer which is given to you. 2-year contract for a consolidated price of 650 rupees. So it's a very simple example. You can add whatever zeros you want to add. This is just to keep numbers simple. Okay. So 2-year contract for a consolidated price of a phone plus a data. Okay. But if you buy them independently, here is the price. If you would have bought phone independently, you would have paid 350 rupees, and you would have bought 2 years of AMC, you would have paid 360 rupees for the data plan, not AMC, in this case data plan. So 350 plus 360, you would have paid 710 rupees you would have paid. But in combo, you are paying only 650 rupees. So how do you allocate? This is how you will allocate. If you see at the bottom, for the phone, 650 divided by 710. 710 is your standalone price into 350 is the standalone price of the phone. That ratio you apply to arrive at what is your transaction price. So in this example, the transaction price for phone and the data would be 320 and 330.
So in this case, earlier I will be showing the revenue under just one head, which is sale of mobile phones.
Yes.
Now I have to split
Yes.
it into two.
Yes. You have to split into these two forms of obligation.
But there will be no impact on the revenue. The total revenue will still remain at 650.
Yeah, it is 650. Timing may change. We will see. Timing of revenue recognition will change or may change.
Yeah, because the transaction price is 650.
It's just overall but the timing may change depending upon which element is being recognized at a point in time versus over period of time. We'll see that also. But the step 5 talks about the timing. Step 5. Now, step 5 says at contract inception, an entity needs to evaluate whether it transfers control of goods or service over time or at a point in time. And this is what the guidance is given here. When we say, I said at the beginning, is a control based model. Now, when you say that the control, I am the seller, you are the buyer. So, at what point in time the control has been transferred from me to you is what we are intending to determine here. So for that, the standard gives you these 5 indicators. Mind it, these are indicators. They are not cut and dried rules. Okay, and they are not also that you have to apply in all together. In the sense that they are not end conditions. You have to apply all holistically to determine when the control has been transferred. And these control indicators are from both sides, customer side, supplier side. From a supplier fact that I as a supplier has a present right to payment is an indicator of the fact that I have transfer control. Likewise, I as a supplier has transferred significant risk and reward associated with the goods and service. If it has been already been transferred, which means it is considered or is an indicative of the fact that I have transferred the control of goods or services to the buyer. Now if you see, out of the 5 indicators which are here, risk and reward is just one of them. Whereas in current revenue recognition model, risk and reward is the only criteria. So here of course it is there, but this is one of the criteria. There are other criteria also. Okay. When it comes to the buyer side, there are 3 things or 3 indicators. Whether the customer has legal title to the asset, whether the customer has taken physical possession of the asset, and whether the customer has accepted the asset. All these 5 criteria you apply together and then take a call whether control has been transferred. And if that happens, then you recognize revenue, and recognize revenue when like this. So revenue is recognized at a point in time when the customer obtains control, or over time if specific criteria is met, which we will see in subsequent slide. So essentially this is a general premise, but when to recognize over a period of time, when to recognize at a point in time is what we will see in this slide. So if you see here, top section, these first 3 buckets, if I'll come back to that, I'm saying if any one of these 3, if these conditions are satisfied, then revenue is recognized over a period of time, else it is at a point in time. Now let us see what are those. So first one, if the customer simultaneously receives and consumes the benefit provided by the entity's performance. Let's say you have a floor cleaning contract for 3 years. You have given to some company. What happens? Every day, same activity is being done. By sweeping the floor, cleaning the floor. Same activity is happening. But the fact in this case is, the day this cleaning happens, the service is provided and consumed simultaneously. Correct? So that's why, if you see here, I'll give an example. Cleaning services or supply of electricity. Electricity is being supplied, we are consuming it right away. It is happening simultaneously. If this is the scenario, then recognize revenue over a period of time. You have given 5-year contract for cleaning. So, because this criteria is met, you apply revenue recognition over whatever the contract period of 3 to 5 years. That's a logical explanation, right? Same way. Next step. Entity's performance creates or enhances an asset that customer controls as the asset is created. So essentially what it means, as the supplier is delivering its performance, you control that asset. So let's say somebody is building a house on your behalf. So as the house is getting constructed, in whatever state it is, if tomorrow that person doesn't want to do it, that will belongs to you. That's what the essentially says. So construction or manufacturing contracts where the customer controls that bit. In that scenario also, you have to do revenue recognition over a period of time. Third one, entity's performance does not create an asset with an alternative use. Let's say if a person is or entity is creating an asset which is specific to your requirement only. It cannot be used by anybody else. Tailor-made, goods are being produced for you. In that case also, you would do revenue recognition over a period of time. But if these conditions are not met, any one of them, so if you see if any of these is not met, then you go to the next bucket, which is then revenue is recognized at a point in time, and these 5 criteria is nothing different from what we saw in the previous slide. Yes, sir.
Regarding the enforceable right
Yes.
payment.
Yes.
Now, there is a one angle to it is the cancellation for contract. So, if the contract there is a cancellation clause, either explicitly or granted by the laws of the land.
Right.
does it mean that we can recognize over time?
No, so again, there is one more thing which has to be looked at. Can you just conveniently walk away, but just by cancelling? Are there significant penalties attached to?
See, cancellation, if the cancellation is from the buyer's side,
Okay.
if the cancellation is from the buyer's side,
Ah.
and there is a cancellation clause, either expressively or impliedly,
Mhm.
and then can the seller recognize revenue over time?
I think so. There should not be any reason why it should not be, because that's a possibility. But then, when you are recognizing, first time you are estimating what is your likely revenue, at that point in time you may have to estimate that, oh, of your total population of customers, how many perhaps will do cancellation.
Okay.
So to that extent perhaps you will tweak down your revenue, but purely if you have to ask me that, can you, yes sir, okay. So these are the 5 steps. So now couple of next slide what we have done, whatever we have discussed, I will just summarize it. So that nothing new concept. So it's more of a refresher, once you go through and read for yourself. This slide again gives you what are those 5 steps, what are the specific criteria which is we wanted to consider, and at each stage, what are some of those things which we already spoke, some of the practical issues which can arise in, corresponding to each of those steps. Given the time, see, this is such a big topic. If you were to devote, entire day can be devoted, but given the time constraint, I have tried to crunch as much as I can so that at least you have a basic understanding of what this standard talks about. And then, of course, whole lot of disclosure requirements are required in terms of understanding the nature, amount, timing of what uncertainties are there, vis-a-vis revenue recognition and the cash flows, what significant judgments entity has made for revenue recognition, what performance obligations, how you determine, there's a whole lot of, these are 5-6 categories of, disclosure requirement, including disaggregation of revenue, okay. So that's pretty much, I thought I can cover on this particular standard. If you have anything else, otherwise this is another interesting area which we should look at, and I think most of us will be able to relate it because this area is of significant practical day-to-day implication. Okay? Financial instruments. Just one thing. Okay? Any idea if you were to look at IFRS literature on financial instruments, how many pages it will be? Any? Why I guess?
I think there are 3.
No, I'm only talking India's IFRS 9.
Close to 1,000 pages.
200, 1,000, any other guess? It is close to 600 plus pages of standard, right? So, and I am trying to cover in 3 slides, okay? So, excuse me, 3 to 4 slides. So, essentially the objective is to tell you what I'm trying to do, make things practically, especially relevant for a landlord kind of a scenario, where you would see law and relate it to what's happening in our offices. So let's see, first of all, classification and measurement of financial instruments.
One slide for 200 pages.
Yes, you can actually it is less than that, because it's 600 plus. Okay. See, if you look at typically when we have a certificate course on IFRS, this topic is almost full day. Only this topic for about 7 to 8 hours is being discussed. That also is not sufficient, if you look at holistically, because it doesn't do justice. 3 slides, certainly not, sir. Okay. So, see, first thing first. I'll start from the middle, go to right, and then come back, which is slightly difficult to understand. But since you are, attending the investor awareness program, you should be able to understand this quite easily. Okay. Let's look at the first one. Derivatives. As we know, morning you already had derivatives demystified, so you know what derivatives is, right? So when you are holding derivatives, the whole purpose you are holding is to the profit and loss has to go to the gain or loss will go to where? Profit and loss. Okay. So that's why. If your financial instrument happens to be derivative, any change in the value of derivatives will go to, if you see at the bottom it says FVTPL, nothing, simple, fair value through profit and loss. So any fair value change goes to profit and loss, that's the meaning. Okay? Next one, if you are holding an equity instrument, you have to ask, let's say if you are holding equity instrument of a listed company, you have to ask first question, are you holding it for trading purposes? You'll buy today, tomorrow you'll sell, again buy, sell, like that. If that is the case, are you holding, so if you are holding the instrument for trading purposes, if the answer is yes, same answer. Gain or loss goes to profit loss. But if you are not holding for trading purposes, you have to ask one more question. What is that question? This question. Has the entity elected fair value through OCI, okay, option for equity instrument that are not held for trading? So this option can apply only when you are not holding the financial instrument or equity, in this case for trading. If you are not holding for trading, you have a choice to make, but that is an irrevocable choice. Once you make, you are forever with that choice for that equity share, for that instrument. So this choice is not at an asset class, but at an instrument level. Okay? So you may say, okay, I am holding the equity share, but I do not want this to impact my profit loss. If you say so, if you choose so, you can do, in that case, the gain or loss goes to OCI. So if you see at the bottom it says fair value through OCI. But there is a catch. Even if you sell the equity shares tomorrow, the gain or loss sitting in reserves will never go to P&L, which means it will move from that reserves to free reserve. But it will never go to profit loss. And that's what you wanted. The fact that you wanted your P&L not to be impacted by the movement is what is being ensured. Okay? This is slightly interesting. Debt set. Take an example of debentures. Plain vanilla debentures. Essentially, so that you are holding it, whenever the maturity is, you will get back your principal. In between interim period, you will get your interest. Okay? So, if you are holding a debt instrument, this first question you want to ask. What is this question? Are the cash flows related to that debt instrument, are they representing solely payment of principal and interest? Again, at an instrument level. In an example of a debenture, yes. What are the cash flows emanating from that debenture, holding of the debentures? Interest and repayment. Okay, so they solely represent that. If the answer is yes, one more question you have to ask. Why you are holding that debt instrument? The debenture you are holding for what? You may this business model can be you are holding to collect the cash flow. You are holding this debenture. You want to collect the cash flow for next say 3-5 year, whatever is the contractual period, right? So hold to collect. So if you meet this condition and you are holding this for hold to collect, then you apply what is called amortized cost, which is nothing but debt amortization schedule. I have explained in an example, we will see that. Okay? So it's like a debt amortization schedule. Okay? That's what you apply. But next thing, second box. Yes, it is called SPPI. If you see here, solely payment of principal and interest, called SPPI, short form. SPPI test met, but business model is hold to collect and sell. Why? I do not know if there may be some requirement tomorrow to sell. Let's say you are holding some surplus investment of your business in a liquid mutual fund. Tomorrow if there is a requirement, you have to make any payment to the vendor. You may have to sell those units and use the proceeds to make payment. So you do not know whether you will be able to hold on to that instrument till the maturity. You may have an opportunity to sell it in between also. If that is the case, you will apply the gain or loss on those will go to fair value through OCI. But with recycling. The difference, if you see, this is also fair value through OCI, this is also fair value through OCI. The difference is when you sell these debt instruments, the profit or loss sitting in reserve can go to profit and loss. Unlike in case of equity, it can never go to profit and loss. That's the requirement of the standard. Third, FPPI is met, but you are holding for sell. You know you are holding it for sell, which is like a holding for trading. Then it will go just like the derivatives. It will go to fair value to profit and loss. Simple concept. Chart looks very complex, but once you understand this, this is how classification works. Now let us see with the example. So here, let's see. City Corp lends rupees 10 lakhs to ABSPL. City Corp was given a loan of 10 lakhs to ABSPL. The loan is repayable in full after a period of 5 years. So you have a 5-year maturity period, and the loan carries 5% per annum, payable annually, even though the market interest rate is 8%. Why somebody is doing charity? If the market rate is 8%, you are paying 5% only. Why? The answer is in the next line. It says, to compensate CD Corp for the below market interest rate, ABSPL pays an origination fee of 1,20,000. So you are paying an upfront fee of 120,000 to that CD Corp. Right? So essentially what is happening? 10 lakh is the loan, but you are paying 120. I told you substance over form. Essentially what is the substance? You are getting only 8,80,000, not 110 lakh. Right? And there is no other, directly related payments. So if you see here, this is how your cash flow stream is. You are actually getting a loan on 880, but how much interest you will pay? You will pay interest on the coupon, applying the coupon to the face value issued. So 10 lakhs, 5%. 50,000 would be your yearly interest for all of these 5 years. The life is 5 years. 5th year, you have 10 lakh of repayment principal also. So that's why in the 5th year, the amount is 10 lakh 50. So if you apply on this cash flow stream, if you apply the IRR comes to 8.01%, which is nothing but your market rate of interest. Okay? Now, when I say debt amortization schedule, your effective loan was 880. On that you apply this effective rate of 8% and compute your debt amortization schedule. So if you look at this is nothing but a debt amortization schedule. Starting with 880, then interest which you will record in the books is not 5% of 10 lakh, but 8.01% of 8.80. Your interest charge in year 1 will be 70,452 rupees. So your accounting changes here. Now you will see your actual cash payment will be only 50,000 because that's what contractually you will pay in year 1. So the payout is only 50. So if you see opening and closing, actually your closing liability has gone up despite making 50,000. Why it is going up? Because of this competition. But eventually, at the end of year 5, it becomes all 0. So if you see, your interest obligation over this 5 period will be 70,452, 72,090. That's how you will record your interest cost in the books. Let's see one more deviation. I'll come back to this slide. Let's first understand. And today, what happens? Let's say you have your office building taken on lease from a landlord. Most of the lease agreement will require you to pay deposits. Okay. Now, let's say it's a 5-year non-cancelable, or assume that's a 10-year non-cancelable lease. So what happens? You give the deposit today, you will receive it at the end of 10 years. Assume that I tell the landlord, okay, how much is your requirement for deposit? Say 1 crore. Okay, 1 crore rupee, my rent is say 2 lakh rupees per month. I work out an arrangement. Okay, I'll pay you not 1 crore, 2 crore deposit. How can you tweak my rent? Naturally, if you pay more, your security deposit rent will come down. Assume there are 2 entities. One entity, occupies 2nd floor. Second entity occupies 3rd floor. Same space, everything same, ditto, same floor. Just because one person has given 1 crore deposit, just because second person has given 2 crore deposit, do you think that the rent should be different in the books? Should not be. Because essentially it is the same space, for which same space same landlord, same locality, maybe same building, and then just because the deposits are different, you have a different rent. That's why this accounting comes into play. It says no. Okay, whatever is your contractual arrangement, the accounting should work in such a way that the rent becomes the same. So your substance takes precedence. How you arrange your transaction should not decide what should be your charge. So with that said, let's see this example. What it says. If you see, this is what the problem statement which I just narrated. It is here. You have a security deposit you gave to the landlord on 1st April 2012. Security deposit, the lease period is 5 years. You have given security deposit of 10 lakh rupees. Discount rate is 12%. I'll come back to this. What is this discount rate? So what this standard says, whether you have given 1 crore or 2 crore, because the money will come back to you after 5 year or 10 year or whatever, you discount that deposit amount today. So assume that for 5 years, in this example, 5 year your lease period, discount for 5 year period, 12% discount rate, discounted present value is not 10 lakh but 5,67,427. So you will record security deposit only at 567,427, but you have paid cash of 10. So security deposit 567, credit bank 10 lakh. What is the balance to debit? This is standard says put it in a prepaid rent account. So the difference of 10 lakh minus 567, 432 will go to prepaid rent. And that prepaid rent you will amortize over the lease period, in this example 5 years. So you see the effect. 5 year, 10 year, whatever deposit, doesn't matter. You do the discounting, prepaid will take care of this. Prepaid you have to amortize in your rent expense over 5 year period. Rent to prepaid rent. So this is how the accounting will change.
And when adjusting the prepayment,
Yes.
can SLM be followed? Or we have
Yeah. So typically you do on the basis of the lease rental charge is how you do. But I mean, if it is not a significant thing, you can. But normally what you will do, the prepaid amortization will follow the same ratio what you do for your rent involved in this entire amortization. Okay, we understood this? So see how things are changing. Today, let's extend this example. You gave the deposit, let's say today is 31st March. You gave the deposit today morning. At the day end, you have balance sheet to be prepared. Of course, you can prepare in a couple of days or whenever. But then, balance rollout when you are doing the balance confirmation. How much is the deposit in your books? 567. How much you will roll out the balance? That's another challenge practically we will have to look at. Because you have to, when you are rolling out, the other side may not be under Ind AS. Contractually you have given cash of 10, you will get back 10. So those things will come up. Okay, we'll move on just in the interest of time. Continuing on financial instruments. Let's see how compound instrument and split accounting works. Simple says, let's say you have a convertible debt. Now what is the essence of a convertible debt? Compulsorily convertible debt. Unlike what we said in the preference. Here it is compulsory convertible debt. So what happens in that? The essence is, till the time this instrument is not converted, it is a debt. And thereafter it becomes equity. Right? So this basically says, let's see with an example, you see that here you have debentures of 2000 debentures, face value of 1000 each, your coupon is 6%, 3 years the term, okay? Then when debenture is issued, market interest rate is 9%, each debenture is convertible into, at any time into 250 equity shares. So what this will tell you? Here if you see contractually, this is how the cash flow is. On this 20, you will pay the outflow by interest will be 120 and this 20 would be your principal outflow. Okay, this is your total outflow which will happen. Then you have to discount it at the plain vanilla discount rate of 9% as if it is not a convertible debt. And in that case, this 18 lakhs, which is the discounted value of cash outflow, that becomes the liability, and the balance 151 becomes equity. So basically, though 20 lakhs, the way it will work, you will record both. You are doing the split accounting, you are recording both equity and liability, and this equity of 151 is something which you will not touch later. So I think we are approaching, some of the other things are there, and we will just quickly wind up, in the interest of time. As I said, lease accounting is changing, okay. Now what will happen? The core changes, if you look at what is going to happen, is that all the operating leases on the books of the lessee, they all need to be converted into the finance lease, essentially, if you have to look at. So basically, all leases will be on the balance sheet. What would be the impact? If you see here, let me just give you the impact. Yeah, this is how it will happen. So what will happen? All your assets, all your leases which you have on the books, you will have to create as a right of use asset in the books. In the balance sheet, it has to come as a right of use asset. Correspondingly, you have to create a liability, which is similar to what we do for finance lease today. So your balance sheet will artificially balloon both sides. It will be grossing up of balance sheet. So you will have a right of use asset, you will have liability also. This is the kind of effect you will see. So at the beginning, you will have assets and liability will be equal, and thereafter your liability will reduce slightly or at a lower pace than your assets. Okay? And when it comes to P&L side, you will have equated depreciation charge, but the liability will reduce slowly. So it will lead to front loading of your charges, and your lease rental will go. So in place of lease rental, it will be replaced by your depreciation and interest. Okay? So that's how it will change your entire finances. Some of the other key, see, I'll just, I think we are running short of time. I'll just take one, there are slides you can go through. Most important thing I'll just like to touch upon is on business combination. Many years back, if you remember, there was a merger between ICICI Bank and ICICI Limited. What happened in that case? In India, what happened? Whether ICICI Bank acquired ICICI Limited or ICICI Limited acquired ICICI Bank.
ICICI Bank acquired ICICI.
Exactly. But do you think that's what actually was the essence of the entire transaction? Is it ICICI Bank that actually acquired Limited? In theory, yes, right. Legally that's what happened, I agree. But if you look at the substance of the transaction, it was not, it was reverse. It was ICICI Limited which acquired ICICI Bank. But we reported here in India as if ICICI Bank has acquired. The same transaction, when it was reported to US Stock Exchange authorities, it was reverse. Okay? That's why when you go to India's and IFRS, it tells you to determine who is the acquirer. Is it, in the example, is it ICICI Bank or ICICI Limited? What is the date of acquisition? Because see, in any case, when the acquisition happens, it does not happen in a vacuum. You may have some negotiation started. Let's say in May negotiation started. Some draft shareholders agreement was approved in September. Then some other internal approval happened in October, and December there was a regulatory approval which was actually obtained on 31st of December. What is the date of acquisition? Is it April? Is it in between period or in December? Very important to decide this, because depending upon what is the date when it is considered that the date of acquisition has happened, that is the point onward you will start consolidating that entity. Likewise on consolidation, today we do the consolidation on the basis of who controls, which means who has the more than 50% shareholding or who has the power to control the composition of board. No longer, yes, it is important, but then there are other factors. You do not look at today, if I have a potential voting rights under new setup, if I have voting rights, I also have potential voting rights. Those potential voting rights are currently exercisable, they are substantive, and I have the ability and willingness to exercise those rights. you have to actually look at even your potential voting rights to decide whether you have control. And if you have that, you have to consolidate. Life is still going to change because the plain vanilla determination of control no longer works. Okay, with that, I think I would like to conclude. My discussion, and also being mindful of the fact that it was till 4 o'clock. If any other query, feel free to reach out. Yes, sir.
You gave a very good example about the compulsory eligible preference share.
Yes.
And the differential treatment.
Yes.
Where the dividend will become like a
Yes.
interest charge,
Right.
which will become a tax desirable item, ideally. Tax desired will not be. So can we create a deferred tax asset on that?
Yeah, so tax, I am not touching this, is a very, very tricky area. I tell you why, because if you look at, you have ICTS also to look at.
Yes.
To that, at this forum, I would not like to comment on this, but yes, there are areas which need to be looked at from the tax perspective. Tax works very differently than what this accounting will say. Okay, so we have to be mindful of that. You are right. There can be potential issues from a tax perspective because we cannot ignore ICS. I only hope at some point in time we will move away with this, and because ultimately it is the same set of government machineries who are issuing these standards. In my mind, I think this is all the more important, requirement at this point in time to actually synchronize all of these, so that those issues like the one which you are referring to should not come. But yes, it's a very important.
Do we have, Chairman sir, one more
Yes,
question?
please.
Can you spend 2 minutes on
Sir, please, I have no problem. Yeah.
cash flow hedge and fair value hedge?
Okay, so this, maybe if we want, we can take offline. It is a very slightly complicated area. This may require me to give you some more context, and maybe we can take it offline. Sure. No problem. Okay, thank you very much, everyone. Hope it was useful to you.
Friends, we have come to an end of our interesting session on accounting as per IFRS. I thank Mr. Anjani Khetan on behalf of Bangalore branch of ICA for his time and effort sharing knowledge to all of us. I thank once again, and I request Sujata to present a memento to the speaker as a token of gratitude and respect. Thank you, Sujata. Now we will break for tea. We will reassemble within 15 minutes. Now it is 4. We will reassemble by 4:15 for the last technical session.